Hey guys, it's Max Convexity. Welcome back to the channel. Today I have a good video for you called The Good, the Bad, and the ULTY. Will it crash? Stick around and we'll find out. All right, folks, let's talk about ULTY from YieldMax. For those of you who haven't heard yet, ULTY is one of the hottest ETFs on the street. Of course, that doesn't surprise me or my subscribers. We've been all over this thing ever since it came out, especially since the strategy changed last October. In fact, I was one of the first influencers to talk about how impressive ULTY is. I even had Jay Pestrochelli, the head trader, on the show exclusively to discuss the new ULTY strategy. All right, so here's the strategy shift that they did last October. The new strategy introduced a trade called the covered caller, which provides downside protection while still generating a yield. Prior to this, the ETF used covered calls, which also pay a yield, but they don't directly hedge some of the downside with put options, which are bearish bets against ULTY's direction. This is ULTY's recent dividend history. As you can see, the average payment is around 80%. They do a great job of paying a yield. And it's especially impressive when you consider that ULTY also has protected downside. Now let's talk about the protected downside. So unfortunately, I've seen some misleading information circulating online regarding ULTY. Now let me state up front, I love this thing. In fact, ULTY, BLOX, and YMAX are, in my opinion, the three best high yield ETFs available right now. New ETFs are constantly being released, but right now, ULTY is in pretty rarefied air. Let's discuss both the advantages and limitations of ULTY, but we need to be realistic about what ULTY can achieve and what it won't achieve. First and foremost, there's no such thing as free money. The put options that ULTY purchases as part of the covered caller strategy will not prevent ULTY's net asset value from dropping. They can slow the decline. As I mentioned, I'm not trying to disparage this ETF. It's truly in my top three. I simply want to prevent anyone who hasn't fully considered the implications prior to investing in this. Now let's head over to Option Strat, and we're going to take a look at the SMR position in ULTY. ULTY at any given time has 15 or 20 stocks that they do covered callers on. So we'll go look at SMR. So this right here is the SMR trade from yesterday or from Friday afternoon. They're long 421,000 shares, 421,600 shares. And then they did 4,216 covered callers. A covered caller is a short call, an out of the money sold call, and a bought out of the money long put. In this particular trade, they sold the 52 strike call and they received $1.50 for it. But they, at the same time, simultaneously, they spent 41 cents out of that $1.50 to buy the puts. So together, the trade brought in, well, about $1 or a little bit more than $1 times 4,200 times 100, because options are in 100, and that comes to $459,000. That's the premium income that Jay uses to pay the dividend with. This trade right here, this covered caller, tied up about $1.5 million. That's the maximum amount of risk in the trade. So they brought in about a 33% credit just on this trade and just for 1 week. That's really impressive, especially when you consider their downside is capped. If the market drops beyond 42, then they don't have to suffer any of that drop. Let me show you the difference between a covered call and a covered caller. All we have to do is take the put off. That's what a covered call looked like. In the old days, with the old build of ULTY, before they switched it, they used covered calls, which are fine. But if they had something that dropped more than 10 or 15%, which is the average distance out of the money their puts are, if they had something that dropped in excess of wherever the puts were located, they would suffer they would suffer a lot bigger decline, and that would go through to the NAV. For SMR's protection to activate, the stock would need to essentially fall below the put strike within the next 5 days. I just don't want anyone to have any false sense of security. Therefore, any drop up into the put strike is fully realized, minus the amount of premium received, and they received a pretty good little amount of premium on there. With this covered caller trade, what this covered caller trade can do is prevent a significant loss from a black swan event, affecting one or multiple stocks in the portfolio. Like I say, they typically hold 15 to 20 positions at any given one time. Let's say the founder of SMR was found to have close associations with Jeffrey Epstein. Well, if this news would probably cause the stock's price to drop. Maybe the stock's price drops 50% in less than a week. Well, this strategy would pay off nicely, and this is precisely what the covered collar strategy is designed to mitigate. On the other hand, if SMR enters a bearish trend but drops less than 15% in a week, the covered collar will not offer any significant protection. Remember, if it were possible to fully avoid a bearish trend and completely protect yourself against a black swan and still have the upside that ULTY has, that would imply that free money exists, which we know it doesn't. These options are typically set up on a weekly basis, with the new covered collar established each week. Therefore, the only thing you're totally protected against is a single week drop exceeding 15% in the case of SMR. SMR, for instance, could drop 10% or 14% every week in a bear market with virtually no help from the so-called protection. Just be aware of that. Now, it isn't all bad news. The income generated from the sold call option can certainly help cushion the NAV's decline in a falling market. The income acts as a buffer, but only if you utilize it as such. If you're withdrawing the income to live off of, especially if you are investing on margin, you might not be particularly pleased with the outcome. Certainly, if you're reinvesting all the dividends, the buffer will help cushion the downside. However, if you're spending the buffer, it won't be as effective. While the income contributes to your total return, it provides the most direct benefit when kept within the fund or if the income's invested somewhere else. For instance, you could use the income to buy government bonds. That would help cushion your downside, far more than if you were using the income to make a payment on your Corvette, or heaven forbid, paying down margin interest with your income. The income can only do one thing. It can either pay down margin interest or it can act as a buffer. It can't do both. Does this mean ULTY sucks? Not at all. Let's look at ULTY's total return since the strategy changed. It's 13.74%, which annualizes to about 18%. Now, that's quite good. This isn't a get-rich-quick scheme, and none of these high-yield ETFs are get-rich-quick schemes. However, ULTY can be a good investment. Now, let's look back at the April pullback and see how ULTY fared and consider how we would anticipate ULTY might perform in the next market, downturn. In March and April, ULTY was down roughly in line with YMAX, which only employs covered calls, not covered callers. If the covered callers truly helped as much as people on the internet are suggesting, wouldn't you expect ULTY to be down less than YMAX? I certainly would. So here's what the covered callers, combined with the income acting as a buffer, are successfully achieving. They're slowing the rate of decline. Here you can see a chart of YieldMax and ULTY. They're both down roughly 14.5% when you look at total return. As for the question, is ULTY going to crash? Who knows? But let's run some numbers. During March and April of this year, ULTY's net asset value dropped from $7.38 to $5.42. That's a $1.96 loss of NAV, equating to a 26.5% decline. Now, over the same time frame, you did also receive 86 cents in dividends. And this is indeed awesome, bringing your total return up to only be down 14.95%. In the same time period, SPY was down 14.65%. That's really good. And to be honest, it kind of surprised me. I had no idea that ULTY protected your capital that well. Now remember, ULTY doesn't control what happens to your capital after you received the money. If you use that money to pay down a high interest credit card, then good for you. However, if you got your mistress a boob job or you bought her a Corvette with the funds, then you're more reliant on the NAV's performance. If you're comfortable with the NAV dropping 26% when the broader market was down 15%, like what happened in April, that's fine. However, if you're highly concerned about NAV erosion, and believe me, I could go on about this, then this is likely not the ETF for you. Someday the market will experience a larger drop than it did in April. It'll likely fall twice as far. When that happens, ULTY's total performance, including dividends, should also be down about 30% in line with the market, if we're using March and April as a proxy. This would be akin to a 2020 size market downturn. I think the market was down 35% in 2020. However, if your mistress still wants to bet, you're going to experience the entire NAV decline. Now remember, in a 30% market drop, ULTY's NAV could potentially fall 53% based on the March and April corollary. It's not a matter of if, it's a matter of when. Now, perhaps the market and ULTY will continue to rise for another couple of years, but at some point, ULTY's NAV will be down 53%. Just be aware of this. Maybe avoid margin, perhaps find a wealthy girlfriend who already has large breasts. In conclusion, is ULTY a Ponzi scheme? Nope. Is it a get-rich-quick scheme? No, and none of these are. ULTY is simply one of many ways to generate a little income in retirement. Check with your own planners. I'm not licensed to give advice. The advice I'm giving you, I feel is good advice for me and my family, but you and your family and your planner have to decide what's good advice for you. Have a good one. This is Max signing off from Hill Country.